Now, the International Monetary Fund says China should expand its stimulus package next year to tackle rising unemployment. Bloomberg's Paul Gordon is with me for more. Paul.
As Linda, very good day to you. Yes, the IMF saying it sees room for targeted additional stimulus aimed at increasing private consumption. That's its words. It says the nation's low level of public debt allows for increased spending beyond the existing $585 billion package. Now, the IMF was unable to agree, though, on whether China's currency is undervalued. The reason for the call for more stimulus, as you note, is that China's shift towards more domestic consumption and less reliance on exports may mean job losses.
Everyone has to stimulate their economy domestically because the biggest source of exports for the rest of the world is still on its knees for some time.
Well, the IMF forecast the jobless rate averaging 4.4% by the end of the year. That's up from 4.1% last year. Hey,
how does this compare with other assessment of China's economy?
Well, this leaves plenty of room for disagreement at Washington dinner tables, I can tell you. The World Bank last month advised China to delay any additional stimulus on concern that rising money supply is stoking asset bubbles. The World Bank, of course, in Washington, and the Washington-based Peterson Institute said this week the yuan is undervalued by 15 to 25%. The yuan, of course, has barely budged against the dollar for more than a year now. Take a look at this chart. There you go, flat for the last 13 months. The IMF's managing director has called it substantially undervalued. Officially, though, the fund hasn't said if the yuan is disconnected from economic fundamentals, and disagreement over how to describe China's currency policy meant the last 2 years of IMF annual reviews of China's economy simply weren't published.
Hey, Paul, currency policy, of course, handled by China's central bank governor, Zhu Xiaochuan, who was in Hong Kong yesterday. He was trying to be rather evasive, yeah?
Yes, him and the rest. Joe at a meeting of 11 Asia-Pacific central bank governors. The grouping EMEAP, it's called, has a website with not a hint of this year's meeting on that site at all. Hong Kong's monetary authority hosted the event, but declined to tell the media when or where it would be taking place. Still, this is Bloomberg. We tracked the governors down and found they were staying at a very prestigious and pricey location.
As Hong Kong tourists and residents watched the solar eclipse outside, Asia-Pacific central bankers were sitting down to a meeting inside, and they chose to do so in the Four Seasons, one of Hong Kong's newest luxury hotels. Room prices at the Four Seasons start at $540 a night. That's almost 8 weeks' wages for the average urban worker in China, or 5 weeks' wages for a Hong Kong-based Filipino domestic helper.
I think if the goal of the meeting is to save the world economy, they should be doing something as an example themselves, to set the example by not spending that much money to have this meeting, maybe stay in a more moderately priced place.
They should meet in a place which is more suitable for the public in general, rather than an elitist hotel.
I don't know what really matters. They just need to get down to the business and sort out the details, I think.
Central bankers in Australia, China, South Korea and Indonesia can point to their economy's relative resilience. All four nations avoided contraction in the first quarter. Still, the Bank of Japan's policy of almost zero interest rates and unlimited lending to banks was unable to prevent a record 14% drop in GDP. The Four Seasons wasn't saying if any of the governors took over the presidential suite. That costs $6,500 a night.
There you go. Just a snip has $6,500. The bankers left the meeting, by the way, by a side entrance. Again, they refused to talk. There's still no statement on the group's website, but China's central bank said on its site that governors did discuss the effect of public sector debt on monetary policy, risk management and regulations, just as you might expect.
Keep tracking them down, my friend. Now, stay put. Let's bring in Arjuna Mahendran, HSBC Private Bank's Chief Asia Strategist. How would you describe China's currency policy? I mean, lots of disagreement. What's your take on that?
Well, I mean, the whole theory of trying to value currencies is fraught with a lot of ambiguity, to be honest. I mean, I speak as an economist. So I'm not entirely sure that you can very objectively say that it's undervalued. And besides, even if you sort of revalue the renminbi, I'm not sure it's going to cure the world's economic ills. Cast your mind back to 1985 when we had the Plaza Accord, when the Japanese yen was supposedly very undervalued. They yanked it up, And what happened thereafter? The Japanese went on a spending spree. They bought the Rockefeller Center and all these wonderful assets, great masterpieces. But of course, they also inflated their property sector in Japan, which created the seeds of the eventual decade-long deflation and recession in Japan. So I think these knee-jerk reactions to currency adjustment are not a panacea for the world's ills. And therefore, I don't think the Chinese should really be shoehorned into trying to do something very aggressive on the renminbi right now. My whole point is we have to just see stability in currency markets for this recession to eventually work its way out. And you know, once the recovery is underway, then I think the Chinese will in any case start revaluing the renminbi just to avoid inflation and all that sort of raising its head in the domestic economy.
Arjuna, Paul Gordon here in Hong Kong. Very quickly, if you can. A related story, bankers under pressure. Here's the front page of the South China Morning Post. The Eclipse sharing space with the Lehman mini-bond bailout. What does this tell you about investment in the future? You can make a mistake with your investment and get your money back from the bank.
Well, I think that's pretty much how it's panning out, in the sense that memories are short. People are now taking risk again. I mean, we've seen the spectacular results from Goldman Sachs, where, you know, they've really extended their trading activity and making a lot of money out of it. And I think that's setting an example. People are plunging back into markets. And of course, the banks want to encourage that sort of risk-taking by compensating those who lost out in the earlier round. So I hope this is a positive sign for the global economy. There's nothing fundamentally wrong with derivatives. It's just that we had some exuberance. So we have to move back into that arena, I guess.
Okay.